Hello everyone, welcome back to Finance Dean Smith. Friends, today I have a piece of news that I absolutely must share with you right away. You might not believe it, but Warren Buffett, the Oracle of Omaha, known for his cautious and conservative style, has just made a move into an industry that almost everyone has avoided for the past 2 years, real estate. Yes, you heard that right, home builders. While most people are still wondering whether the Federal Reserve will cut rates, and if so, when, Buffett has already acted. He's put real money into a sector that Wall Street practically declared dead. According to the latest 13F filing, Berkshire Hathaway opened a brand new position in Dreyer's Horton. That name might sound unfamiliar, but this is the largest home builder in the US, consistently ranking #1 in new home deliveries. And Buffett didn't stop there, he also added to his holdings in another giant, Lennar. In other words, this isn't some casual trade. This is a carefully planned move. Buffett is placing a heavy long-term bet on the housing sector. But let's pause for a second. Do you still remember what the US housing market has looked like over the past 2 years? The Fed went on an aggressive rate hike spree. 30-year mortgage rates shot above 7%. Young families were priced out of the market. Existing homeowners, sitting on 3% mortgages, refused to sell. The entire resale market froze, with transaction volumes falling to the lowest in over a decade. US media even described housing as frozen solid. In this environment, most investors believed buying a home was too expensive. Builders were doomed, and real estate was the most hated sector on Wall Street. And yet, here comes Buffett doing the opposite. When others are fearful, he's greedy. When others see no hope, he's laying the groundwork. So here's today's big question. What exactly does Buffett see that others don't? Why is he betting big on housing stocks right now? Is this tied to the Fed's expected September rate cut? And could this move trigger a chain reaction across the US stock market? Just a few days ago, I talked about renewable energy. Many people dismissed it, even left comments saying I was wasting their time. But what happened? On Friday, solar stocks exploded. Names I highlighted like Henf jumped 25, Run surged over 30%. So let me remind you, don't dismiss what you don't fully understand. Even if you've been investing for 10 or 20 years, that doesn't mean you can't be wrong. Today's video is just as important. Stick with me until the very end because I'll share a list of actionable companies you can look at directly. Alright, let's break this down along Buffett's line of thinking. First, why would he dare to bet on home builders right now? Second, how critical is the Fed's September decision, 25 basis points or 50? And finally, what ripple effects could lower rates have across other sectors of the stock market? So why housing, and why now? The answer boils down to two words: interest rates. For the past 2 years, one of the biggest themes in the US economy has been high rates. To fight inflation, the Fed pushed the federal funds rate up to 5.2555, the highest in over 20 years. 30-year mortgage rates climbed above 7, pricing out young families and freezing existing homeowners in place. The housing market was practically paralyzed. So why would Buffett buy into such a terrible environment? Doesn't that go against common sense? Here's the key: Buffett doesn't care about today's high rates. He cares about tomorrow's lower rates. Look at the data and it's obvious. First, inflation is easing. Core PCE fell from over 5% at its peak down to just above 3%. It's not at the Fed's 2% target yet, but the direction is clear. Second, the labor market is showing cracks. Non-farm payrolls aren't beating expectations anymore, they're being revised down, sometimes massively. July's revision was nearly 90%. That means the once hot job market is cooling fast. Third, growth is slowing. Manufacturing PMI has been stuck below the expansion line, and consumer confidence keeps sliding. Put these signals together and the story is clear: high rates are weighing on the economy, a hard landing risk is real. So what will the Fed do? Stick to high rates? Or ease up? The market already has its answer. CME FedWatch data shows the probability of a September rate cut climbing fast. By 2026, markets expect 75100 basis points of cuts in total. In other words, whether you believe it or not, the market is already pricing in rate cuts. The only question is, what are you doing? Will you wait until Powell actually cuts rates? By then, markets may already be running hot, you'll be late to the party. And which sector benefits first from lower rates? The answer is obvious: housing. Every 1% drop in mortgage rates saves a family with a $500,000 loan around $300,400 per month. If rates fall from 7% to 5, that's over $600 in monthly savings. For young families, that's the difference between can't buy and finally buying. So Buffett isn't betting on today's fundamentals. He's betting on the inflection point in rates. He knows that once the Fed loosens, pent-up housing demand will flood back in. And by the time you think about buying dryers Horton or Lennar, those stocks could already be sky high. Friends, that's Buffett's mindset. While others stare at today's freeze, he's planting seeds for tomorrow's spring. But housing is just the first step. Lower rates ripple far beyond. Let's break this down. Housing supply chain, building materials, home improvement, durables. When mortgage rates fall, more people buy homes, new construction picks up. That benefits companies like Sherwin-Williams Paints, Masco Bath and Kitchen Fixtures, and home improvement retailers like Home Depot and Lowe's. REITs highly rate-sensitive assets. Over the past 2 years, REITs have been crushed by higher financing costs, but once rates fall, valuations recover quickly. Data center REITs like Equinix and Digital Realty or multifamily REITs could rebound strongly. Mortgage REITs are trickier, too sensitive to spreads and prepayments, better for short-term trades, commodities and emerging markets. Lower U.S. rates weaken the dollar. That boosts gold, resource assets, and capital flows to emerging markets like Mexico and Vietnam. Fintech often overlooked but potentially explosive. Unlike traditional banks, fintechs don't rely on net interest margins. They operate lighter, consumer-facing models across lending, payments, and investing. High rates hurt them, but lower rates cut funding costs and boost risk appetite. Take Sophie, for example. In a high-rate world, its lending business was pressured and growth slowed, but once rates fall, its loans become more competitive. While its trading platform benefits from higher investor activity, fintechs are essentially double leveraged to lower rates, cheaper funding, and more active users. Compare this with traditional banks. Their margins actually get squeezed when rates fall. Investment banks like Goldman Sachs benefit from more deals and IPOs. But fintech's dual engine of lending plus trading gives them the most upside. SOUC. Buffett's move isn't just about real estate. It's about positioning for the entire rate cut cycle, but we also need to be cautious. Why is the Fed cutting? Not because the economy is too strong, but because cracks are forming. That means much of the rally could be liquidity-driven, not fundamentally sustainable. Think of it like inflating a balloon. The harder you blow, the faster it pops. That's why you shouldn't blindly chase overvalued megacap tech at their peaks. There are plenty of other opportunities: housing, REITs, commodities, fintech that are earlier in the cycle and carry better risk-reward. So what's the bottom line? Buffett isn't just buying a couple of homebuilders, he's betting on a new market regime, the shift from high-rate tightening to low-rate easing. And history shows, at the start of every rate cut cycle, one sector takes off first. After the 2008 crisis, it was housing and commodities. After 2020's COVID cuts, it was tech growth stocks. In 2025, if September really marks the turning point, the leaders could very well be housing and these other rate-sensitive plays. So don't ask, will home builders still go up? The real question is, will you recognize the logic in time, or will you only chase once it's too late? Buffett's already placed his chips. What about you? Leave your thoughts in the comments. What sectors do you think will benefit most in this coming rate cut cycle? I'll see you in the next video. This is Finance Dean Smith. Thanks for watching.